I expect gold to continue to rise based on the back of these continuous string of policy mistakes by the Fed that, is now in a trap of its own design, and it can't escape. And so the result is ultimately going to be a dollar crisis and a sovereign debt crisis. The people who think that you can ignore gold's rally because the bond market isn't collapsing, the dollar's not collapsing against other fiat currencies, a dollar crisis, if you wait for a bond crisis to protect yourself, you've waited too long. By then, it's far too late to do anything. Right now, you still have the opportunity to protect yourself. You still can buy gold and silver.
Gold's rise is no accident. It's a direct reflection of monetary failure. The Federal Reserve, trapped by its own reckless policies, continues to cut rates in a misguided attempt to sustain an already fragile economy. Every move only deepens the hole. Gold, meanwhile, is acting precisely as it should, exposing the weakening credibility of fiat money and signaling that the next major financial crisis will not be a banking crisis, but a currency and sovereign debt crisis. The illusion of stability in the bond and dollar markets is just that, an illusion. The longer this persists, the more violent the eventual revaluation will be. PeterSchiff, veteran economist and founder of Euro-Pacific Asset Management, has long warned of this precise outcome. The Fed's so-called soft landing is merely the calm before the storm. Gold's surge past $4,000 is not a speculative move. It's the global market pricing in the Fed's failure. While mainstream analysts ignore these warnings, the smart money is already positioning for what comes next. As the dollar's strength erodes and inflation quietly eats away purchasing power, the window to act is closing fast. Now, we present the clips from PeterSchiff's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you.
Gold was completely MIA at the Federal Open Market Committee meeting. Now, considering the fact that gold is the main monetary asset, central banks now have more gold than U.S. Treasuries, foreign central banks. You would think that the rise in the price of gold would at least have deserved a question. I think it should have been front and center. I mean, the Fed should have to address that elephant in the room. But no, the topic was never even discussed. And I've mentioned on my podcast that Alan Greenspan, who people call him the maestro, and he's still held in high regard, including by, a lot of members of the Trump administration who speak about him. He specifically said that gold was his barometer of whether or not he got interest rates correct. That even though we weren't on an official gold standard, unofficially we were, because Alan Greenspan still looked towards the price of gold as a market indicator of whether or not rates were too high or too low. And so what he told Congress was $400 gold meant he was too loose, and $300 gold meant he was too tight. And so he was kind of eyeing for around $350. And so if the price of gold stayed around $350, that would indicate to him that he had got interest rates about correct. Well, if $400 gold meant that Greenspan was too loose, what does $4,000 gold mean now? What is that saying about the Powell policy? Clearly, if 400 was represented too loose money back in the 80s, well, then 4,000 certainly must represent the same thing. And so that's why it should have been brought up. And by the way, my last podcast, I titled it Gold Test $4,000 Support. And some people might think, well, obviously it failed the test because now we're below 4,000, which is the case. We did end up falling below it this week. And in fact, gold closed below 400 today, although it did trade above 4,030 this morning. But it closed below it. As I'm speaking, we're up about $20, but we're still just below 39.50. But also on my last podcast, when I talked about 4,000 support, I did say that it was very likely that gold would go below 4,000 and that 4,000 could be support even if the market was to go below. because I think it's going to be similar to the way we handled the 3,000 support. It wasn't like 3,000 was some line that we couldn't cross. And the same thing with 4,000. We get below it. But whenever you get below it, you are in a support zone. And just like the market never fell too far below 3,000, I don't expect it to fall too far below 4,000, nor do I expect it to stay below 4,000 for any long period of time, because that would give too many people the opportunity to buy it below 4,000. And I don't think that's going to be the case. So I still think that we're at 4,000 support, even if we're trading at 3,950. I mean, we're close enough to 4,000 to say this is where the support is. Obviously, the resistance now is closer to 4,500 because we did get up to, I think, 4,400, because we got up to like 4,380. So we didn't quite trade 4,400, and then we had the pullback. But even with the pullback, where the price of gold is today is considerably higher than it was the last time the Fed cut rates. And the fact that the Fed is cutting rates and the gold price is going up is not a coincidence. Gold is reacting to a Fed that should not be cutting rates. Rates are too low, and the Fed is making them lower. And so the rate cuts are a mistake, and gold is clearly signaling that it's a mistake. Yet none of these journalists who are invited to ask, Powell questions understand enough about money or economics to ask the question or to point out that gold is flashing a warning, or they don't understand the warnings themselves, right? Because, they have to flunk a test on economics before they could be a journalist, an economics reporter at a lot of these newspapers or television networks. And then, then they get to ask these questions to Jerome Powell. So anyway, this was more BS today from the Fed. I expect gold to continue to rise based on the back of these continuous string of policy mistakes by the Fed that, is now in a trap of its own design, and it can't escape. And so the result is ultimately going to be a dollar crisis and a sovereign debt crisis. The people who think that you can ignore gold's rally because the bond market isn't collapsing, the dollar's not collapsing against other fiat currencies, that's all wishful thinking. All this stuff is going to happen. The fact of the matter is people are losing confidence in all fiat currencies, not just the dollar. But at some point soon, you're going to see the dollar losing a lot of ground relative to its fiat counterparts. But of course, if you wait for a dollar crisis, if you wait for a bond crisis to protect yourself, you've waited too long. By then, it's far too late to do anything. Right now, you still have the opportunity to protect yourself. You still can buy gold and silver.
The Federal Reserve continues to chase its own shadow, cutting short-term rates while long-term yields rise and inflation remains entrenched. Despite acknowledging that Americans are frustrated with high prices, the Fed refuses to admit its role in creating them. The solution isn't more inflation or catching up wages, it's restoring the real value of money. Yet Powell's insistence on maintaining a perpetual 2% inflation target ensures prices will never come down. They will only rise at a slower pace. This policy guarantees that purchasing power will erode indefinitely, leaving savers and workers poorer over time. Proper stability doesn't come from printing money or stimulating artificial demand. It comes from savings, production, and sound interest rates. The Fed's rate cuts do the opposite. They suppress savings, fuel debt, and expand credit without creating real growth. The result is an illusion of prosperity built on borrowed money and delayed pain. This dynamic, repeated for decades, is what leads to the currency and debt crises now approaching. The longer the Fed pretends to manage inflation through manipulation rather than restraint, the deeper the damage becomes to the very economy it claims to protect. Let's get back to the interview.
You're going to continue to get more increases between now and the December meeting. So I think that rates will be higher when the Fed meets again in December than they were in November when they cut. And so they're lowering short-term rates, but long-term rates are not cooperating. They are going up. But I think the most significant thing about today's announcement was Jerome Powell stating on multiple occasions and really going out of his way to state this. Why are the people still upset about inflation? Because you claim inflation's come way down, but people are still upset. And Powell says, yeah, they are upset and they have a right to be upset, right? He said the reason they're upset is because even though inflation has come down, prices have not. And he admitted that prices today are a lot higher than they were a few years ago. And that is why people are so upset, because the high prices haven't come down. In fact, they're still going up, right? So if prices were too high and now they're going up, even if they're going up a little, you're still making a bad situation worse. Now, I agree with what Powell said. Yes, the problem is prices went way up and they never came down. But whose fault is that, right? Why doesn't Powell, or why doesn't somebody ask Powell, okay, then why are you targeting 2% inflation? If you admit that prices came way up and they never came down, why don't you target falling prices, right? Why can't the Fed pursue policies to bring prices back down? Because that's what the public wants. Why can't they get it? Because remember, right, when inflation had been too low, according to the Fed, right, it was below 2% for a few years. The Fed said, oh, no, we need to average this up, right? Inflation's been too low. We've been below 2%. We need to average it up to 2%. So we need to run monetary policy a little hot because we need to make up for all the years where inflation was lower than 2%. Well, if you admit that people are pissed because prices are so high and inflation was way above 2% for so long, why, based on the same rationale, why is the Fed not targeting inflation way below 2% to average all that high inflation back down and to deliver actual relief to the American consumer who he claims he cares so much about, right? Oh, we're here to help the consumer with price stability. Okay, well, that means we need lower prices. We don't need prices to go up by 2% a year. We need prices to come down. And in fact, they need to come down by a lot more than 2% a year because they went up by a lot more than 2% a year, right? If prices went up by 6, 7, 8% in a few years, why can't they come down by the same amount, right? I think people would be very happy, would be very relieved if they had that kind of price decline. But no, that's completely off the table because as far as the Fed is concerned, it doesn't matter how high prices go up. They always have to keep going up, right? So if we have 1 year where prices go up by 50% in 1 year, the Fed wants to make sure that next year they go up another 2%. So you're at 52% and then 54%, right? We can't have prices go up 50% and then go down by 10%. Oh no, that'd be a disaster. We can't allow that. This is what Powell is saying. That's why it's not that this 2.5%, 3% inflation. You have to look at it in the context of all the inflation that preceded it. We do need lower prices. We need much higher interest rates to bring the price level back down. Instead, what Powell wants is, he said, it's going to take a while. We need wages to catch up to prices, right? And that way people can afford. So in other words, he wants more inflation so that people can get higher wages to afford the higher prices that resulted from the inflation of the past. But of course, the policies that he is pursuing to increase wages will also increase prices. So it's going to be like a dog trying to catch his own tail. It's never going to happen. In fact, Powell said that the reason they want to cut rates, right? Because he said we're in a good place, but we're in a challenging place. The good place is we got all this economic growth, we got full employment, but he said the risk is to the upside to inflation and to the downside to employment. And therefore, we're kind of, in a difficult spot because, if we want to fight inflation, we got to hike rates. If we want to fight unemployment, we got to cut rates. We obviously can't do both at the same time. We got to pick one. And so this is a difficult position because we're not really sure, which road to go down, right? But when he was explaining it, he said that the reason that they're able to stimulate employment by cutting rates is he said that rate cuts stimulate demand. And by stimulating demand, we create jobs. And that's not true. I mean, maybe that's what the Fed thinks, but you don't create jobs just by stimulating demand. You actually create jobs by stimulating supply. And supply is actually curtailed by these rate cuts because rate cuts encourage more consumption, but only to the extent that you borrow the money, right? Because lowering interest rates just makes it cheaper for you to go out and borrow money and buy stuff. But borrowing money and spending it doesn't grow the economy. It does push up prices, right? So you get higher prices when the Fed makes it easy for people to go out and borrow money and buy stuff. But what really grows the economy and creates real employment is the production of stuff. And by artificially lowering interest rates, the Fed actually discourages production. What we need is higher interest rates so that we have more savings to finance more capital investment, to finance more production. So we make more things. And it's the supply that ultimately creates real demand. And that's where we get good jobs. We don't get good jobs by expanding credit, right? That's what the Fed wants to do, is expand credit. Well, that's create inflation. I've already described that inflation is not just an expansion of supply of money, it's an expansion of supply of credit.
The illusion of control is fading fast. The Federal Reserve's rate cuts are no longer tools of stability. They've become acts of desperation. Each move to stimulate demand only deepens the very inflation it claims to fight, eroding savings, destroying real wages, and punishing those who live within their means. This cycle of manipulation and denial is leading America toward a breaking point, a loss of confidence not just in policy, but in the dollar itself. As the Fed prioritizes short-term optics over long-term health, the foundation of sound money continues to crumble. Proper recovery won't come from cheap credit or artificial demand. It will come from honesty, accountability, and the return to real value. The moment to act isn't after the crisis, it's before it erupts. Protect your wealth, stay informed, and prepare for what's next. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.